Good day, all. Ira Epstein of Linn Associates with your agriculture update, and this is for Monday. Yeah, we're back from Easter and Passover holidays. It's April 22nd, 2019, just after 3 p.m. Central Daylight Time. So when we look at the agriculture markets, with the good weather that's finally coming back into the U.S., the central part, it's near 80 in Chicago, to give you an idea. It was gorgeous yesterday, too. You're getting some pressure as farmers are going to move back into the fields. Keep your eye on the wheat market. It has a seasonal tendency to start slipping from this point. In the energy markets, by now I'm hoping that you've heard that the U.S., with the waivers as to what it's done, it is canceling all the waivers that it had issued for 6 months to 8 countries. And so Iranian oil is supposedly not going to be allowed there without U.S. sanctions to those countries. We'll see how that all works out. Dollar index slightly down as you're getting a little bit of a bounce in the euro. It was one of these days where the market's just sort of waiting and people coming back. It was very strange, very quiet trade. Stock market still within just a percentage point in some of the indices of getting up to all-time highs. Big earnings season as well. So when we take a look at what soybeans are doing, we know it's down 3.5 cents today, so that's how much it's down for the week so far. And you've gone from 9.25 to a new low close, let's call that, of 8.77 since that high close was hit. When we take a look at the chart action, we can see how the market keeps slipping to the downside. We haven't yet heard anything on Chinese-U.S. trade, although there is a meeting scheduled, I believe it's April 29th, another trade talk, and then May 5th. So the goal has been of the Trump administration to keep pushing it back, but to try to get a deal done with China in the month of May. A big question, of course, is how does China react and what does it do to the trade talks, because a major buyer of Iranian oil has been China. We'll see what happens with that. It's still an unknown. When we take a look at the swing line study, and remember what swing lines are if you're new to these videos. What a swing line does is I created this indicator so that it looks at one of several things. In fact, it looks at 5 things to decide should the current line from the lows of Friday, actually it's Thursday, be up or down today. And it looks to see, are you having a higher high day, a lower low day, an inside day, an outside day up, or an outside day down day. From there, I set up the rules so that I can easily look, and number 2, I don't get to make a decision. Is the market trending, not trending? What's it doing? Is it an uptrend or downtrend? My definition of a downtrend, which is what soybeans are in, is this. If a market's making lower highs and it has lower lows, it is in a downtrend. That's what this is. The risk associated on this current formation would be to end the downtrend if prices got back over 9.15 3/4. You can see that's very, very far away, roughly 25 cents. Then I put on a filter called the 18-day average of closes, and I'll also put up on the agriculture markets the 100-day. I really don't use the 200-day very often on these type of charts. I look for the resistance, number 1, to be what I call that line in the sand. You'll notice how often markets play at that 18-day average, and then they'll either move up or down from there as they decide to go into a trend. Just hitting this number back and forth like it was doing right through here, and I can show that so easy. What's the trend? I don't know. The market's making lower lows and it's got a higher high at that point. When it breaks out to the downside, then the swing line starts defining it. And as you can see, this was on Tuesday of last week, and the market starts moving away. The next thing I look at is where could potential support come in. Now, I have different ways of doing this. I use window envelopes, which you don't see on these studies, and I use Bollinger Bands. Those are 2 of the ways that I look at this. In the black dashed line, the odds of a market staying over or under it is 5% of the time. When you have successive closes under or over it, I count each successive close as taking away one of those percentage points of the 5. So if I had 2 days in a row where it closes under the lower Bollinger Band, I'd say you have a 3% chance then of it's doing it again. What the market's doing now is bouncing away from it. It hit the support, and often as you hit supports, doesn't mean it has to be the exact low. It's a zone where I think the pros are taking some money off the table. Doesn't mean they're changing their position. They might be looking to sell the market back higher. You look also to see what's going on with momentum. Is the momentum pointing up, down, sideways? Is it overbought, oversold, or getting stronger in a direction? In this particular case, it's oversold. So I have a market that's in a downtrend. It hit 3 days ago, the first support. It's bounced back up. In fact, it's over that first day that it closed under it. You can see that right what it's doing here. You're getting a small bounce. The oversold condition might hold the sellers back a little bit from selling even a minor break. They might just decide, let's see what goes on. In the meal market, this is called running the Bollinger Band. And the difference is you're not trying to close under it like you did in beans. You just keep hitting it and pointing it down. That's a more bearish situation in my opinion. It's the same one in the sense the pros, I think the first time you hit the band, and we concede the first time. This day's low was 307.20. The Bollinger Band was 307.20. The low, 307.20. So it both hit the Bollinger Band, settled there, hit it again, and it's just riding it to the downside. Again, oversold. Soybean oil, it's when you have a crush spread, often meal goes one way, oil goes another way. There's a demand and too much supply on one or the other. And what we have here is lower highs, lower lows, a market coming back into resistance at the 18-day average of closes, which is 29.15. Today's high was 29.13. But any reading in the slow stochastics under 30 is oversold. I don't think the bears are getting overly aggressive, is my point. You made one run towards the lower Bollinger Band right through here. You got as low as 28.72. The band was 28.70, and you bounced away from it. In the corn market, we have a market that's got lower highs, lower lows. Bearish. Yes, the market is oversold. Both numbers are under 20 today. If we go to Thursday, they weren't. Therefore, you're just in an oversold market. Maybe it'll reach down for the Bollinger Band. Could. If you were to take out 367 3/4, what the trend would be, as I define trend, you'd break the pattern of lower highs and lower lows and neutralize it. It does not mean the market's turning bullish. So that would be one number I think the bears are looking at. In the wheat market, this is a market that's having trouble playing, just getting back over the Bollinger Band. So you're under it today. You were under it on Thursday. This was last Wednesday. The market finished out the day at 450 1/4 under the Bollinger Band. That's 3 days in a row. This was your fourth day. So the odds tomorrow, and that's all that it is, my rule of thumb, it doesn't mean it has to be this way, is there's about a 1% chance of the market staying under the Bollinger Band. It simply means that the market, in my opinion, instead of selling under the band, some of the traders will have a better shot, if they're going to go short, over it. Now, if you were to take out 453 3/4, you got a couple of issues. Number one, you're oversold in the market. You're not embedded. Embedded means you're keeping both numbers under 20 several days in a row, at least. You didn't do that come last Thursday. So you're just plain oversold. If you got over 453 3/4, the odds would favor that the market might see more short covering. But because it's under the 18-day average, my definition of bias is when a market's under the 18-day average, it has lower bias. Over it, upside bias. So that's the number the bears might want to defend, is not getting over 453 3/4. Remember what we just said about Bollinger Bands. The odds of going outside of the bands and staying outside, 5% of the time. So it's not uncommon when the market first hits a band to see professionals covering if they're short the market. Buying, no. That is not what the theory of Bollinger Bands is. It's one thing to cover a short. It's another thing to reverse your position. I don't know what you'd be basing that on. The theory is it won't be under it. more than 5% of the time. So I think the pros cover there. You got up to the upper band. If they were long, and I'm not saying they were or weren't, I would look for the resistance to be that number. If you look at Friday or Thursday, because we weren't open Friday, 1301 was the high, 1303 was the band. Today you went up, hit that band, and pulled all the way back down, finished at 1277. So I'll stay with my theory that that's what I think the pros use it and how they use it. Now, in the coffee market, we stepped out of a trend. Let me show you what I mean. This is a downtrend, lower highs, lower lows. You hit your Bollinger Band here, bounced back into it, got back down. Let's see if this day it did it. The low that day, excuse me, was 92.20. 92.31 was the lower Bollinger Band, so you had hit it, you bounced back. You went down again for it on Wednesday, bounced back on Thursday. Now, if we look at the high here, it was 94.20. This day's high is 93.65, so the trend is still down. I'm going to stay with what I've been showing you. Number one, momentum had been oversold right here. As the red line starts turning back up, that's a shift in momentum. It does not mean price has to follow it, but so often is the case, momentum leads price. And that's what I believe. I don't believe that price sets momentum. I think it's the other way around. If it's going to break the downtrend, you've got to get over this 94.20 area. And if it does it, I'm going to look for that line in the sand, as I call it, that 18-day average, to possibly offer the first resistance point. The market goes up today, hits that number, and as you can see, stalls out at that number. In fact, reverses course in a major manner and drops away over 200 points from it. So that's what I think happened. I think the shorts got out, you came up, and then the market ran out of momentum against that number. In the cocoa market, we have a couple of events happening. Momentum turned down. You can see this right here. This was called embedded. And this is when you're over 80 several days in a row. In the stochastic terms, markets by the traditional way either get oversold, overbought. When this study came out, the gentleman that did it was George Lane, and I became a student of his, learning this from him. And I said, George, I'm noticing a phenomenon. It's something called, I'm going to term it embedded, locking in. But when you lose that locked in part, the market often makes a run back to what I'll call this line in the sand. And you did that right there. Now what the market's doing is not only has it done that once, now the market's setting itself up with lower highs, lower lows. The bias is down because you're under the 18-day average of closes. Potentially, and that's all I can say, if this doesn't act as resistance, the 18-day average, maybe the market goes to the 100-day to see what's going on down there. In the cotton market, you have a longer-term area here of lower highs, lower lows. Now, what happens on this also is with this formation, you can also argue you've got higher lows. Do you see that? I can go back to this one to argue it because the legacy, as I want to call it, is the high was made first, then the low, then you come up and this high, as it turns out, didn't take out that one and you fell back on Thursday. See it? As long as that high's not taken out, I'll stay with the legacy of lower highs, lower lows. Now the market comes up today, and it shifts the bias of the market up, but not the trend. What do I define? The trend by the swing line, but the bias is up because of you're over the 18-day average. Should the market take out 77.77, what will happen is you'll have the bias down, you'll have the swing line again confirming another down leg, and possibly, that's all you can ever use, is the market make a run for the Bollinger Band and the 100-day average. Conversely, if the market were to take out 79.25, even though that would confirm the higher lows and a higher high, you'd be into the Bollinger Band. That's an area where I'd expect pros to come out of the market, not buy it. In the cattle market, you were in an overbought market that went through a cattle on feed report that saw a 1% increase in placements last Thursday. It's a longer tape than normal because we've got a lot of ground to make up. You've got higher lows, higher highs. Again, the first challenge of the Bollinger Band is what I teach in my charting course, where I think pros start coming out of the market. And admittedly, this is in front of the cattle on feed report also. We go home, and today the market breaks down. off that report. Feeder cattle market comes down a little bit. It's still in an overall uptrend with higher lows, higher highs, but it is very overbought with the stochastics. And in the hog market, I think this is a crowded trade. Let me define crowded. It means too many people on one side. They're all counting on China to be buying all this meat. You were down almost the limit today. You finished down 297 points. Limit down is 300 points. If you'd like to know more about my research and how I do what we're talking about here, how to understand what it all means, let me get you set up with it. And simply put, what it does, it's my commentary. And in my written commentary, which comes out at least twice a day, I'll come out at about 11:30 in the morning, and then I'll come out before 8 at night with what I think today's events are offering, what the market's looking like. You will receive free limited access to my subscriber video in the morning. The only people that are going to get this are people that haven't tried me before. And if you do it, what will happen is this is how a written update will work. You will get access to our mobile application. You will have access to our charting software. You will have access to my audio commentaries, everything basically I'm putting out, so you can make a decision, does this fit in with your style of trading or not? It might not. You might want to see it. It might offer things you haven't seen before. How you get your free access, give us a call, or you can go to our website, www.iraepstein.com. You'll see our carousel of free offers. Take a look at those, choose what you want, we'll get it to you. Sorry for being longer, a lot of ground today. You have a good day.